Parks Capital, where education plus investing equals success.
Hi everyone, I am your portfolio manager Rajiv Dixit and welcome to the market outlook for the second quarter of 2023. Last time we talked, I left you with a few key points. Let's recap them. First, we believed at that time that most of the inflation problem was priced into the financial markets, and we were then in the bottoming phase of this correction. Second, inflationary pressures had started to reduce, and we expected that trend to continue. Third, we also believed that the aggressive rate hike action by the Federal Reserve should start to slow down and that the Fed is less likely to raise rates at the same pace in the future. Fourth, because of the above points, we believed it was time to start deploying the cash reserve into areas of opportunities like the fixed income market, the international markets, and many more. Here we are, 3 months later, and I'm happy to report that many of those critical points still hold true. Inflation in the US is continuing to show signs of easing, or at least not growing at the same pace as last year. The Federal Reserve's rate hikes have also started to slow down, and the expectation of future rate hikes has significantly reduced. The economy is also showing signs of resilience, with unemployment levels still at near all-time lows and consumer spending continuing at a healthy pace. For our last discussion, we made significant changes to our portfolio in the previous quarter. We have deployed the cash we raised in January of 2022 in a new bond portfolio. That portfolio is comprised of short and intermediate term bonds. We have added additional exposure in emerging and international markets and are allocating cash in areas of the market that would benefit from a stable Fed funds rate in the near term. While all of the above changes in the portfolio align with what we discussed in our last outlook, we have also made additional changes to the portfolio that we still need to discuss. Primarily, we have reduced our overall exposure to US equities wherever possible, tax-wise and warranted. Today, I want to discuss with you the reasons for this strategic change. Since we last talked, two significant developments have given us cause for concern in the near term for US equities. The first development is the consecutive failure of two major banks in March of this year, the Silicon Valley Bank and the Signature Bank. In March, I wrote in detail about our views of these bank failures. If you still need to read that article, I encourage you to do so. The link of the article is in the description below. What concerns us in the aftermath of these bank failures is not so much that many more banks would fail in the US. Although possible, it is less likely to happen. What concerns us is that due to these bank failures, regulators like the Federal Reserve, FDIC, and even Congress will impose stricter regulations on small and mid-sized banks, leading to an overall reduction in lending to businesses and consumers. In light of this developing situation, we have significantly reduced our exposure to small cap stocks in the portfolio, as smaller companies are more likely to be affected by this change in lending conditions. For this reason, in the near term, caution is warranted. This banking crisis also comes with a silver lining for our portfolios. The crisis significantly curtails Federal Reserve's ability to increase interest rates in the near term. They just can't do it. Why is that good? As I had previously mentioned, we just installed a new bond portfolio this year. Usually, a reduced expectation in future interest rate hikes by the Fed results in higher bond prices as investors are more comfortable holding bonds when they expect the rates to remain stable or reduce in the future. So, there's something to celebrate in all this negativity around this calamity. The last point I want to highlight about this crisis is that it also comes with a valuable lesson for a long-term investor. What we need to learn from the Silicon Valley Bank failure is the value of liquidity. What is liquidity? Liquidity, simply put, is the ability to turn any investment into cash without any restrictions. In the case of Silicon Valley Bank, its failure to prepare for a crisis like a bank run and its inability to liquidate its long-term bond portfolio quickly led to its ultimate demise. In the coming months, we will provide a detailed piece about the importance of liquidity and its role in our investment strategy while selecting investments for your portfolio. The second event that gives us pause for concern in the near term is the looming debt limit situation in Washington. Unfortunately, it is not uncommon for the US government to ask Congress to increase the debt limit to pay its bill. Happens all the time. But this time around, the divisive political environment and the lack of progress in negotiating this bill is a cause for serious concern. Again, I want to clarify what the true concern is here. It is not our concern that this issue will not be resolved in the long term and that US will default due to the inability to pay. We are not Venezuela. The concern is that any delay in passing the debt limit that leads to a delay in payments on the current debt will create volatility and instability in US and the equity markets. As you know, gold is a great safe haven in times of instability and geopolitical panic, and thus would serve as a hedge if this crisis were to come to fruition. In anticipation, we have started a new gold position in our portfolios. We will continue to monitor the progress in Washington and manage our portfolios accordingly. Despite the above-mentioned concerns, many parts of the market still show strong signs of recovery. Bonds, technology stocks, and others have shown significant strength in these initial stages of recovery from the correction. We believe this trend to continue going into the second quarter. While volatility is still to be expected, we continue to invest in these sectors for long-term growth. In summary, despite these near-term headwinds in the US economy, our long-term outlook for equities and bond markets looks promising. These headwinds are opportunities that, if managed appropriately, can provide an excellent catalyst for long-term gains. Additionally, you know that charts primarily determine our outlook, and those charts continue to show underlying strength on the long-term basis. We're excited about the future and are confident that our investment strategy will continue to protect us in times of turmoil and generate positive returns in times of growth. Remember, as long-term investors, we have the luxury of patience and the ability to parse out the noise. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we are seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or during our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parx Capital is managed based on who you are. Thus, they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We're looking forward to talking with each of you in your quarterly review meetings. Remember, education plus investing equals success.
Here at Parx Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.